Hello everyone. Today is another serious episode of VCTalks by Big Global Ventures. My name is Alibek Sultangazna. I'm advisor for the development. And today I'm pleased to announce our collaboration with Mr. Robin Butler, the partner of Sturgeon Capital. Robin Butler is an investment officer with a huge experience in investing into startups in emerging markets. Collaborating with institutional investors such as International Financial Company, SBI Holdings, and Chevron. And today he will be talking about the main points in startup valuation in venture investment, a discipline at every stage. Key topics of the webinar will be valuing the startups at different stages, how to determine fair market value and avoid overvaluation. The second is investment discipline, strategies for making well-informed decisions and managing risks. And third, common valuation mistakes and how to avoid them. But taking account Mr. Butler's huge experience, I think he'll go sometimes beyond this outline that we have talked about with him. So we hit about 30 minutes, 40 minutes presentation by Mr. Butler, and afterwards we can answer your questions. Thank you so much, Mr. Butler. The floor is yours.
Thank you very much, Alibek, Amina, and the rest of the team at B Global Ventures. Apologies in advance if this is not as detailed as I would have liked to have been. Been a bit unwell the last couple of days, or last day or so. But thank you so much for having me, and looking forward to digging into a topic which is one that we think about a lot at Sturgeon. I think there is a challenge in the industry we work at, that valuation, especially at the early stage, is more art than science. There is a balance between clearly the ownership stake as an investor that you want to have, and managing the relationship with the founder and their dilution. It's a function of many factors that are kind of some beyond your control, some within your control. In the end, valuation is about the only form of risk management you truly have as an investor, as an early stage investor, because coming into a deal at a $6 million versus a $20 million valuation makes a significant difference to the upside, assuming you put the same check in, to the upside kind of scenario that you need to actually make money. So the way I was going to kind of go through this, I'll give a bit of an introduction on sort of Sturgeon and what we do, and then use a kind of actually just a simple Excel model, which it's hopefully useful in its simplicity. Just kind of talk through how, as an investor, one should be thinking about valuation as a function of the fund size that you have, as a function of the check size that you are able to write, and also the type of businesses and the markets that you are operating in. So just to kind of kick off, a little bit of background on Sturgeon. So we invest in teams building transformative businesses in emerging Asia. We have over a 10-year kind of track record of doing that. So far made 38 VC investments across 11 countries, and have somewhat of a unique approach in our on-the-ground presence in the regions that we invest. Kian and myself have been working together for, say, seven and a half years now. Total, we've launched 5 funds, raised around 300 million across both venture capital and private equity strategies. Supported by a fantastic team of experienced entrepreneurs and investors, and backed by both large institutions like the IFC, SBI Holdings, and Chevron, but also a mixture of other kind of smaller strategics, smaller in the sense of the amount they have invested rather than anything else, and also family offices and high net worths. If you want to learn a bit more about us, obviously you can check out our website. We have a Substack blog as well, Terra Incognita. Actually just published another article today on why we invested in Farrell, Kazakh founded company, but published a lot of our thinking around how we look at deals and various other things on there. I guess kind of what sets us apart from say both international and local investors is that we're kind of a hybrid between the two. So we have on-the-ground presence in Kazakhstan, Uzbekistan, Pakistan, Bangladesh, and Georgia. We like to position ourselves as that hybrid local international investor that can see close to 100% of deal flow, carry out the qualitative due diligence and quantitative due diligence on each company that we look at, and then really add value post-investment, because the majority of these individuals have been founders themselves, been investors previously, so have the connections and the understanding of what it takes to build a business in these countries. But we're also not sort of a single country fund. We like to think that gives us the ability to learn from mistakes and opportunities that have happened in other markets, and help reduce our own error rate as an investor, but also reduce the kind of mistakes that our founders make. And then we look to match, let's say, the kind of the team that we have with capital and strategic support to actually go and build these businesses into the kind of market leading ones where we invest. Just what emerging Asia is a concept that we came up with. So just to give you a sense of what it actually means to us, it is Central Asia, the Caucasus, and South Asia ex-India, so primarily Bangladesh and Pakistan. What kind of unifies these countries is that they have high smartphone and internet penetration, but levels of technology adoption, and here Kazakhstan's a bit of an outlier, but it's typically lower than in other comparable emerging markets. Countries like Indonesia, Vietnam, Indonesia, Turkey, Brazil, Mexico. And our thesis is that these countries over the next 5 to 10 years will go through the kind of rapid technology adoption these other markets have seen. And that's the way for us as an investor to make money. And also as these businesses kind of transform what is a region of 500 million people and $1.4 trillion in GDP. Kind of depends who the audience are today as to what they kind of how much context they have. But often when we're speaking to investors in Europe, the US, or elsewhere, they have limited understanding of the size of the opportunity, but also the dynamic at play already. So what we like to do is highlight some of these companies that have already been successful in multiple markets. I'm sure most folks, if anyone in Kazakhstan or in the region, is very familiar with Kaspi. It recently expanded to Turkey with its acquisition of Hepsi Barada. TBC expanding from Georgia to Uzbekistan. Daraz operating across kind of South Asia. bKash, a purely Bangladeshi business. And the reason we emphasize these is this is not a sort of total pie in the sky idea. There are already substantial things happening in these markets, and substantial in terms of sizable businesses with large user bases generating significant revenue and sort of plus $1 billion, in Caspi's case, $20 billion valuations. And our view is that there's a lot more to come. I mentioned before kind of Turkey, Brazil, Indonesia, Mexico. We see these markets as being 5 to 10 years ahead of the countries in our region, and cumulatively they've produced over $50+ billion businesses. Many of these names will be familiar to you, some may not be. But what's also important, and I guess kind of ties into the sort of valuation discussion we have here, is you have some of the top performing venture funds globally have operated in these markets. The Early Bird Digital Lease Fund is a second fund that backed UiPath, delivered plus 20x DPI to its investors. Their first fund also performed very well, having backed Peak Games. Kajek in Brazil and Mexico, sort of plus 15x DPI on its early funds, and Open Space was a fund in Indonesia, backed some of the early leaders there, and sort of a plus 35% net IRR. And that this is sort of truly top quintile or top percentile venture returns. You look at kind of what the median is across markets, and even actually there was a recent study come out from Carter that top decile sort of small fund returns, which are predominantly in the US, sort of TVPI is around 2x. That is not particularly strong returns, particularly when you balance it against this and the level of risk that has been taken. This is slightly repeating what's been said before, but is just going to emphasize it's important that as an investor, as excited as one can be about a market or about an opportunity, and you can invest in great companies. If you can't exit them, it doesn't matter. These are some examples that have come out of the region. PayMe in Uzbekistan, sort of plus sort of around $115 million valuation for the second tranche acquisition by TBC. Cloudways out of Pakistan, acquired for $350 million a couple of years ago. shop up a large secondary transaction, similarly actually with Bcash as well. The reason, as I said, for emphasizing the exits is when you look here, so you have a range of from around 100 million up to 20 billion. Now, as much as we want to live in a world where we back the kind of $20 billion company at seed stage, the reality is, especially if you're investing in these markets, is that let's say I think the modal kind of outcome is going to be somewhere from 100 to 500 million, and that has a significant impact on the kind of valuation or the invest deals that one should be making in the valuation one should be investing at. Now, one can take a different strategy and say, I'm going to back businesses that I think have that path to 10 to $20 billion. But you look at the kind of historical track record in these markets, and say even TBC today, which has operations in multiple countries and is arguably undervalued relative to kind of its performance, especially in Uzbekistan over the last few years, is still only, and I say only in inverted commas, valued at $3 billion today. So all of this to give a bit of context on kind of what I then want to do with this Excel model. If you just give me a moment. Okay, let me know if you can, when you can see that.
Yeah, I can see your screen. Thank you.
Brilliant. So the reason for having this up and not some kind of nice presentation is A, I'm terrible at making presentations, but B, I think it's more effective to kind of look at the numbers, use numbers as a way of assessing kind of what sort of valuation one should be comfortable investing at, and the kind of determinants of what success would look like. What I've done here is basically kind of 5 scenarios ranging from $1 million fund size, which is not even really a fund, is most likely a kind of an angel investor portfolio. Sort of maybe a $10 million is a kind of micro strategy pre-seed fund. $25 million, probably a fund 2, kind of seed, predominantly seed focused. 50 million, probably somewhere between seed and Series A, and maybe 100 million focusing more at sort of Series A. That clearly means you write different check sizes, and you also will typically have kind of different target returns. If you're making your own investments, or you are really a micro fund, so you have the ability, because of your small fund size, to do a very high multiple on invested capital. This in row 3, so you have kind of from 20x on $1 million fund to actually 3x on $100 million fund. You'll notice in the end returns more capital to investors than the kind of performance on a smaller fund. It's why in some ways you see a lot of investors tend towards raising larger funds that pay more management fees, and actually the return hurdle becomes lower, but it still doesn't make the job necessarily any easier. Row 4 is just to say, well, what does that actually mean in terms of how much capital you want to be able to return? This entry valuation one, we'll play around with this on kind of different deals that one might be looking at. I've made some assumptions on what your investment amount might be depending on this fund size, and this is an initial check. You may be able to follow on, probably not if you're the angel portfolio or the sort of $10 million fund. But if you're a $25 million fund, you might have some capital reserve for follow-ons, which is important when it comes to your dilution till exit. If you can take pro rata even in one round, especially the sort of, let's say, from a seed to Series A, you may mitigate 20% of the dilution that I've assumed here, and that could have a significant impact on your overall returns. This entry ownership is a function of is a function of the check size you're writing and the valuation you're coming in at. Dilution till exit, this is probably aggressive, but let's be aggressive because for the sake of it, and then kind of exit ownership. Final couple of ones to point out. Row 12 is basically what you are underwriting if you are making an investment. In this case, we're saying $20 million entry valuation, and you're going to put in a 100K check. You're underwriting that in order to, your fund size in this case being $1 million, in order to make $1 million, you need this company to be worth at least 400 million. Now, we're talking sort of US venture type things. Yeah, that's not a crazy assumption, which is why you might well see plenty of sort of $15-20 million pre-seed rounds in the US. But I'm thinking about this looking at this particularly from a kind of more emerging markets context, as you saw earlier, that business Cloudways that was acquired for 350 million, that took 9 years to build, was doing a little bit over $50 million in revenue with a 40% net income margin, and that was acquired for 350 million. So you've got to be pretty confident that you're saying, well, at least I'm getting to 50 million here. And I would say in this case, a $20 million valuation would be a pretty expensive one to pay. What you'll see is, and then final one, 14, is what you would need to 5x your fund. Now, I know we've got here that, to deliver your target returns. So delete that. Target. So in this case, I'm saying I want to 20x my $1 million. I'm saying actually this company on its own needs to be worth 8 billion. Maybe it is. Maybe it is, and you walk away with one of the single greatest sort of angel check investments we've seen. We'll see. Again, I'm looking at this from a context of emerging Asia. That's bigger than TBC Bank, which has been built over 20 odd years, operates in multiple countries, and does hundreds of millions of dollars in net income. I'm not to say it isn't possible, and we are operating in a kind of in an industry that is defined by power law outcomes. But the point I'm just trying to make here is that it's unlikely that that's going to happen. What I want to show is, I could say you're playing around, and I'd say if you're this angel portfolio, you probably want to be investing at $4, $5, $6 million valuations, not 40, because you see what that kind of means on, let's say you're doing these 100K checks, you're putting money in at a sort of $4 million valuation. You make your money back if this business is, let's say, worth 80 or 100 million. Now, we're not here just to make our money back, but you see the difference that it makes between putting money in at a 4 million valuation and then putting money in at a 20 million valuation. The key thing I'd make the point here is that it's easy to think, oh, some big investors sort of giving these guys such a high valuation. Like, let's say we put it back to 20 and it has this $25 million fund that you look up to. You think they're a kind of big investor, and they are putting in, let's actually say they're going to put in, they're putting in a 500K check. Now, that for them may actually be a good deal, because maybe they can avoid dilution later on and they can own a bit more. And you see how they actually manage to make money in what is not a kind of bad scenario for them. But actually for you, it may not be a good investment. So I think the sort of signaling too much of what other investors are doing can be risky, and why discipline, particularly at this early stage, is so important relative to the amount you're able to invest. Now, if I were putting this 500K check in at a 4 million valuation, I'm taking a big ownership stake. I've got to be able to sort of, I think, back that up probably with follow-on capital and these sort of things. But my exit scenario to return the fund, which is clearly a much larger fund size, drops down to, what would you say, only 400 million. Again, I would probably still be a little bit cautious on this, partly because I would probably have assume lower dilution. What I can do, I'm happy to share this round afterwards. But what I think it is, say you're looking at a few things that are the kind of levers that you as an investor have to pull in this fund scenario. A is kind of one thing you have from the beginning is, okay, how big is my fund and what is my target return? But you have, let's say, the entry valuation you can come in at, the amount that you can invest, and the amount that you can follow on with, i.e. follow on bit, how much can you minimize your dilution till exit, which will also be minimized by investing in good companies that grow their valuation significantly and you face less dilution. But let's assume the seed round is going to be 20% dilution, the Series A is going to be 15 to 20%, Series B is going to be 10 to 15, and then maybe another couple of 10% after that, depending how the company scales and grows, all of which eats into your returns. The smaller the fund size you have, and let's say the smaller the check size you have, the lower the entry valuation you want to be coming in at. The larger the fund size, the balance, and we saw this in our first fund, and some mistakes we made were in some cases finding a fantastic deal, but that deal having, I don't know, a 50 $50 million valuation, and you put in 500K because you think, yeah, this is great. I think this company is fantastic. And that's not to say it isn't a fantastic company. And being invested, you might learn a bunch of stuff. But the chances of that delivering, let's say, meaningful returns for the fund are pretty small, to be honest. Like, let's say if it were a $500 million exit, you here are walking away with 2.5 million, and or so 2 million, which is not going to make your investors particularly happy. Now, if you're a sort of early stage investor, maybe that's actually not a sort of terrible outcome for you because it's just your private money and you're walking away and you're okay. But that discipline on managing it correctly at a fund level is very important, and sizing the investment size correctly, coming in at the right entry valuation, building the right ownership stake, is what will define if you are someone that wants to be running kind of venture funds, multiple venture funds, and build a kind of generational business, will be what defines you. Because let's say you had a scenario where you were invested in a $1 billion company, but you owned 0.1% of that, and you had a $25 million fund. That's going to be, it's going to look nice, it's going to sound nice, your friends are maybe going to think you're impressive, but LPs are going to look at that and say, no, it wasn't really a very good investment for you. It was a great company, and it was great that you managed to put a bit of money in, but it wasn't actually a good investment for you because relative to your fund size, it didn't deliver the returns that you need. This is where I think I partly make my apologies that I haven't gone into more sort of detail on things. Those were the points that I really wanted to make on why valuation is so important as an investor, how it really is the only thing that kind of mitigates risk for you over time, and the kind of levers that you have to pull while you are investing at whatever stage and whatever kind of fund size that you have in your back pocket. Alibek, if there was anything else you wanted me to kind of go into more specifics on before we open up to Q&A, very happy to do that.
No, it's clean sweet, sir.
Fantastic. Well, then I guess if anyone has any Q&A, I don't know how you want to do this, but
yeah, unfortunately, we don't have any questions in our chat, but I have one question for you, sir. So, with your experience in our region, what are the most maybe common mistakes that sometimes when startup team is very confident in projections of their metrics before pitching the investors? What are the main mistakes maybe that they do, or maybe also from the side of the investor, what things that they should be more attentive with while looking through the pitch and the documents, the materials of the startup? Thank you, sir.
Sure. So there's a slightly sort of now overused and cheesy phrase or sort of concept of this, the surfer and the wave, kind of early stage investing, and I'm sure most people are familiar with it, but to run through it, is that the wave is the kind of market that you're investing in. Is it big enough? Does it have the right kind of momentum? And I think what's important there, if you're doing due diligence on a company, or if you're a company that's going through due diligence, how you've thought about that market matters. You put $100 billion addressable market on there, most people are actually going to go, it doesn't seem like this person really knows what they're doing. And you shouldn't. If you see that and be like, that's a big number, and it's not even your addressable market. It's certainly not your attainable or obtainable market. Being realistic and specific shows that you have a kind of clear understanding, and to me as an investor, it says, okay, this person really knows what they're talking about. You have the surfer, which is the kind of founders, and what we like to do is to get to know founders over a slightly extended period of time. So ideally to speak to them kind of before they're raising the round where they want to raise money from us. If I can know someone for sort of 6-12 months, that's perfect. Don't always get that luxury, but that's what we want to do and what we try to do. And on the flip side, if you're a founder, we say, well, okay, if I can know this investor, if I can keep them regularly updated, that means sending monthly, quarterly updates, maybe having a call every sort of 3-6 months, building a relationship of trust, saying, I'm going to do X, Y, Z, then going away and doing X, Y, Z shows that you can execute, shows that you're moving in the right direction. Maybe X didn't work out, you can explain why. All of these things kind of build trust with an investor. And from the investor perspective, I get a sense of really how this person actually operates. And let's say maybe you have the perfect CV, but you actually kind of back that up with what you do on the ground. And then you have the board being the kind of product. Is it actually solving the kind of the problem? For me, the most powerful is always kind of what is the end user feedback. So if we're looking at a B2B business, we'll always sort of want to speak to some of the customers that are actually using the product. What do they say about this product? Do they sort of speak about it like it's something they could never do without? Do they describe it in the same way that the founders have described it? And then from the kind of founder perspective, and for a more consumer facing one, you can look at various reviews and other things are usually pretty telling. If you're a founder, being kind of aware of this, that you want to sort of show the flashy slides and all this sort of thing that it can do. But any kind of user feedback is incredibly valuable. If you're a B2B product, I think particularly being able to show data on the impact you have had on your customer. Like, did they grow revenue? How much did they grow revenue? And you have was it like 85%? Because if it's a specific number, then I'm like, okay, that really seems like you've been tracking the benefit it had. Did it reduce time? How many hours did it save for them? How much did it save them in cost? Whatever it may be. And then on a consumer side, it's maybe a little bit different. You probably have more of a kind of customer feedback surveys or whatever, NPS scores or whatever it may be. But how can you show the investor that what you're doing is really solving the problem that you're solving and delivering the value that you say it's delivering? Because that to me means, okay, you're going to have customers that are loyal, that like the product, are going to hopefully increase their spending on the product over time, going to have high retention, and that's all good things for the money that I can make as an investor.
Okay, thank you so much, Robin. We finally have a few interesting questions from our audience. So if I may, Bobek Turikhanov is asking, can you comment on this, Robin, about the valuation of B2B SaaS startups in Central Asia? What kind of money multiples are they looking for? Is it range, average, median, other key metrics? Please, Robin.
So look, okay, let me start from the sort of the end of the equation, which is i.e. like kind of what exits have we seen for B2B software companies in the region? And the two that I'd highlight would be PayMe and fintech infrastructure type thing, but still, and Cloudways. Now, both of those were acquired at roughly a 7x ARR multiple, or sort of last 12 months revenue multiple. Both of them doing sort of 30 to 40% net income margin, so very high margin, high growth, substantial revenue businesses. The reason I kind of highlight that is to say, well, if that is what the exit multiple is likely to be, that's what I've got to kind of assume as being my range at exit, let's say 5 to 10x annual revenue. From that, if I'm looking at this as an investor, I'm saying, well, okay, what do I think? What is the revenue potential of the company that I'm investing in? Is it 10 million? Is it 50 million? Is it 100 million? I know the kind of multiples I'm looking at. So in that case, I'm saying you're anywhere from, if you're from 50 million to $1 billion. Now, that's quite a broad range, but I want to kind of judge what can that software company generate. And let's say, I think if you look at purely Central Asian or actually former Soviet Union kind of software businesses, I think the largest one today does about 20 million. And we're talking subscription revenue. Like, this is the largest one. One of the couple of the Russian companies have grown to about 20 million, Bittrex and Ammo CRM and those kind of guys. So that's at the moment is kind of the upper bound. Now, yes, the markets are changing. But if that's where I'm saying my upper bound is, when I'm then coming back to look at how I value revenue today, I'm judging a little bit against what I kind of see as being the long-term potential. So sort of long and short of it, if you're an early stage B2B software company and I'm paying a sort of 25x revenue multiple for you today, considering, and let's say that's putting you at a sort of $20 million valuation, considering, let's say your upside is, if you're only in that region, is capped at maybe 20 million in revenue, and I'm saying that's maybe a $200 million exit, that's probably not good enough for me. So it's why when we're looking at B2B software, this is kind of subscription revenue businesses in the region today, I think you need to have a vision that is broader than just Kazakhstan or Central Asia to justify the kind of multiples that in your mind you're thinking, well, that's what I see companies in the US raising, but they're just playing a different game in terms of the market size they're operating in and the revenue that they can generate.
Thank you so much, Robin. We have one more question, and it is, what role does qualitative analysis, example, team assessment, market dynamics, play in valuation? I would like also maybe combine it with the red flags that you mentioned in the beginning of your presentation. What can be the red flags consequently?
Okay, so I think the qualitative points are really the reasons why one should say yes or no to a deal. I think this is the right founder in the right market, and market has a quantitative aspect to it, but it also has the qualitative aspect of what are the kind of market dynamics and the competitive landscape and these sorts of things. And if I really believe in the founder, then this then becomes a deal that, as much as the kind of quantitative side is often the sort of, well, is there a reason in here that says I shouldn't do the deal? I.e., this business model has like 1% gross margins. Like, that's just going to have to be so huge to be successful that it needs so much money to get there that probably not a good deal for me. Or is there something that just the market size itself is not large enough? So you say, well, actually, and we've had this a few times where you say, well, fantastic founders, think at some point we would love to back them, but just this is not the right business model. This is not the right market opportunity for them. And it would be a bad investment for us to go ahead and try and invest in this founder as much as we're kind of excited by them. So that, I think, would be, say, kind of how sort of the dynamic is playing in the investment decision. And then how much does it impact valuation? Say I have kind of three steps to how I think about kind of valuation, and this, it's a red flag or like a warning sign, or things to be careful of as founders. It's kind of tied into this, is make sure you have enough money. If you're going to raise money, raise enough money. And this is true on, like, it's important on both the downside scenario, but also the upside scenario. Like, if you don't have enough money and things aren't working out, you don't have the runway to figure them out, and everything's going to sort of come apart. On the flip side, and almost maybe even more frustrating, if things are going better than expected and you haven't got enough money to be able to capitalize on it, you've got to go back to market, you've got to raise more, and probably you haven't justified the previous valuation you raised at yet. So it's maybe a flat round, it could even be a down round. It's just going to be a nightmare in terms of what happens. So making sure you have enough money to hit the targets that you're saying you're going to hit and that are going to justify the next round valuation for you and for your investors, and a little bit to spare, so that in the downside or upside scenario, you do have enough money. Second point is, have you got the right investors? And the right investors take many different forms. Maybe they're strategic because they can help you enter a new market. Maybe they're strategic because they can help you with some regulatory challenges you have. Maybe they can help you in hiring, go to market. Maybe, and this will be an important one, they can provide follow-on funding. So it's a small check for them now, but actually they could lead your Series A, and having them on board would be fantastic. This is a kind of thing you see more in the US. Maybe the sort of partners have a small fund where they can make opportunistic investments. That's a really kind of fantastic thing to have. So if you've got the right amount of money and the right investors on board, the valuation kind of should take care of itself. And optimizing too much for valuation today, like a percentage point here or there, or this sort of thing, is not going to be what defines the success of your company. Like what defines the success of your company, and I'm not talking like found like those someone putting in 500,000 for 40%. That's going to kill you. Like absolutely don't do that. But if you're looking and it's like, well, it's between a sort of like 15 and 18% dilution today, but either I have the great like the investor I want and the money I want, or I have a bit less money and it's kind of from dumb investors. Don't optimize for that, because having the right investors and the right amount of money significantly increases the probability that you get to the next round. In 18 months time, maybe you're raising, today you raise 3 million, in 18 months you raise 10 million, or in 12 months even. Now, if that 10 million happens at a 50 million or an 80 million valuation, that's again going to be a function of the sort of the support that you've had. And then if you're able to raise that 10 million, it significantly increases the chances of you raising the sort of 20, 30, $50 million round after that. And then at that stage, dilution becomes less. You can maybe take chips off the table, but none of that matters if you don't get there. So how does, sorry, I will sort of come around. How does founder fit into all of it? It's all kind of a big package from a founder perspective, and then also as an investor perspective. I think if you optimize, you get the right amount of money, you get the right investors on board. Those investors don't have a big enough stake in the business that they care about it, which is a function of their fund size and what we talked about earlier. You increase your probability of success, and that's what you want from a funding round. And over optimizing for a couple of percent here or there is, in the short term, does not help you in the long term. And the flip side of that is, I think a real red flag or a real risk for founders is raising incremental small amounts of money at incrementally higher valuations, because that valuation then becomes a benchmark that any new investors looks at. And raising 100K at a certain valuation, if you're then trying to raise 5 million, that 100K is insignificant relative to the 5 million. But if that's benchmarked against some stupid valuation, then you just create more problems for yourself when you then come to sort of sit down with a bigger, more serious investor. So again, to try and avoid that sort of mission creep. If you're going to raise money, raise enough money, do it quickly, do it seriously, and then just give yourself the ability to focus on execution.
Wow, this was truly funding 101. Thank you, sir.
Yeah.
We're a bit of run out of the time, so one final question, Mr. Butler, before we finish. So how do you balance the risk of volatility in frontier markets with the potential for outsized returns? And what role do local founders play in tipping that balance?
And let's say the reason that we're investing in these, why I like early stage technology investing, is because it does have that ability to deliver those outsized returns, which can deliver the sort of risk adjusted returns that are commensurate for taking the risks of investing in emerging markets, because you have currency risk, you have geopolitical risk, you have sort of macroeconomic risk, you have the families of whoever's in charge doing stupid stuff, risk. Like there are a whole bunch of things that you have the risk of revolution, of invasion, that let's say is less likely elsewhere. And all of that is risk that needs to be paid for with returns. And if you kind of look, top quartile, top decile private equity returns in the US are, I think, about 30%, or 20%, I forget exactly off the top of my head. A kind of emerging market premium would be about 10%. So you're looking at a sort of 40% IRR that you should deliver to be able to truly justify someone putting money in emerging markets. And that's very difficult to do over a sort of 8 to 10 year horizon, 8 to 12 year horizon of a fund. And so that's why I think venture is an attractive one, because it can do that. Again, you come back to the valuation discipline and making sure that if you do hit the big one, you hit the big one well. And I think it's like when Early Birds he was on the 20 VC podcast the other day, and I think saying at peak they owned about 18% of UiPath. They came in, I think, at a 6 million pre-money valuation. I put $1 million check in. So they started from a sort of strong position of ownership. They were able to double down to increase that ownership over time. And it did 18x on a $150 million fund on its own. Now, that's a right tail outcome. which you could have been a smaller investor in that and owned a small percentage and said, yes, I was invested in a great business. But to deliver sort of cumulatively 20x DPI on a $150 million fund is truly exceptional, and is the opportunity that comes if you're disciplined in how you actually construct your portfolio and the valuations that you invest at. So I don't know if I may have sort of slightly sidestepped the exact question, but hopefully that gives a bit of context.
Thank you so much, sir. Taking into account your connecting flights and constant traveling, we thank you very much once again for finding time to join our VC Talks. Much more to come, I guess. So hopefully see you next month in Kazakhstan. Stay safe. And yeah, thanks for our audience for your questions. Unfortunately, we haven't been able, due to the time issues, ask all of the questions, but we will keep that in mind and maybe use them during another sessions with Robin and wider community of B Global Ventures. Stay tuned up, guys.
Thanks very much, Alibek.
Take care. Goodbye.
Cheers. Bye.